Welcome to Top of Mind, the show where we talk to real estate industry insiders and experts about the biggest trends impacting the market today. Enjoy the show.
Mike Simonson here. Thanks for joining me today. Welcome to the Top of Mind podcast. This is where I talk to the smartest leaders, thinkers, doers in the real estate industry and related industries. For a couple of years now, we've been sharing the latest market data every week in our weekly Altos Research video series. With the new Top of Mind podcast, we're looking to add some context to the discussion about what's happening in the market, but from leaders and others in the industry, so beyond the data. Each week, Altos Research tracks every home for sale in the country, all the pricing, all the supply and demand. We analyze all that data and all the changes in that data and make it available to you before you see it in the traditional channels. So you can visit altosresearch.com for more details on how we do that data. But without further ado, let me introduce our guest today. Conor Sen is a Bloomberg Opinion columnist who writes about financial markets, the economy, housing, cities, and demographics. He's also the founder of Peachtree Creek Investments and has more than a decade of experience in portfolio management and risk management. I often look to Conor for his broad economic and financial market expertise and his insights into the big picture of what's happening in all the financial markets. Conor lives in Atlanta, which is one of the hottest real estate markets in the country right now. He writes about Atlanta. So we're going to talk about Atlanta today too. So welcome, Conor. Thank you for joining.
Thanks, Mike. We've been talking to each other for, I think 15 years was the first email I sent to you. So it's great to finally chat in person or over the internet.
That's right. It's really great. I think when we were just starting Altos Research a long time ago, you're one of the first people on Twitter to see what we were doing and respond to it.
Yeah, what's fascinating to me is, as somebody who's really loves working with data, that mid-2000s period was when we brought a lot of data and democratized data in the real estate market. And so I think that's, your work has really helped me to bring that data to the public and allow practitioners like me access to it.
That's awesome. So we get to talk a lot about the data today. But first, tell us about you. Tell us about your background, about Peachtree Creek, and how you ended up writing for Bloomberg.
Sure. So when I first emailed you, that was when I had just moved to San Francisco to start working for a hedge fund. And, I saw, I forget, probably on a blog or something, that Altos was this data organization that had housing data. And I was at this hedge fund really interested in what was going on in the housing market in late 2005. And so, thought that Altos could help me with that. And so my background is in computer science and economics. That's what I studied in college. And I sort of love the intersection of the two of those. And I think housing and data really sit in sort of both worlds. And so I was in San Francisco for about 5 years, from 2005 to 2010, working in risk management. The housing market, of course, was a huge part of that during that period. And then living the tech world as well, just being in San Francisco, sort of got burned out living there, had a breakup and decided to move to Atlanta, where I had a couple friends and worked for a tech startup here for a little bit, and then eventually went out on my own. I sort of, wanted to flex those hedge fund muscles, but without the crazy schedule that working for a big hedge fund entails. And Twitter was a great way to stay engaged in that world as well, being in Atlanta and not in an office with a lot of other similarly minded people. And so, slowly but surely, you grow a following, you talk to people, you learn more. And that Bloomberg kind of came out of that, where I was talking with a lot of journalists and columnists, and Bloomberg was looking for people to write, and somebody pitched my name. And so I started doing that about 5 years ago.
I really like the work you do with Bloomberg. I like the insights that you trigger from it. I like the way you take you recognize trends that are happening and you really present them in a real cogent way. So I want to talk to you more about that work. Tell me about Peachtree Creek. Is that
sure?
Is it what kind of company is it?
Sure. So it's a registered investment advisor, and it's just me. I'm a one-man shop, and I just manage money for clients. A lot of times, friends and family and referrals, individuals. And again, it's just a way for me to stay engaged and help people and manage money, but without the big stress and chaos and infrastructure of a big firm.
I see. And when you do that, are you primarily doing equities, or are there other things like like real estate investments or stuff
it's all publicly traded securities. So there's some housing related equities at times, but it's sort of, I'm kind of a tops down person. So it's a lot of different sectors and depending on what interests me at the moment and what I think is interesting.
Got it. Oh, that's great. So you've been doing that for like 10 years now.
Yep.
That's great. It's nice to see that develop as like as a testament to the quality of analysis that you get to do.
And I've been remote work from day one. So when the world shut down in March 2020, the biggest change for me was my kids with daycare and school. But in terms of work, it was like, okay, I'm already working at home with my dog. So that's not a change.
That's not change. And the other big change that I've observed is that everybody else is all of a sudden finally good at using Zoom and like confident at doing those things. So it's okay to have a video phone call.
Exactly.
So okay. So at let's start here. We call the podcast Top of Mind. What's top of mind for you right now?
So right now, your work has been so helpful in terms of explaining what's going on in the housing market from somebody who works with the data and creates the data themselves. And so the inventory situation and sort of you've pointed out the surge in new listing prices and price increase percentages and things like that, that tells you about demand and supply and demand in the housing market. The part that's interesting to me right now is that home builders and a lot of people are saying, well, we expect 10% growth given strong demand, given that they're trying to grow. And I don't think the supply chain can handle that this year. So that, to me, the story of this year might be that everyone's projecting 10% demand based on, or 10% growth based on strong demand. And then it could just be because there's so many bottlenecks between appliances and cabinets and garage doors and siding and windows that the market really only grows to maybe 3 to 5%. And that to me is, especially in a time of rising interest rates, I think there are a lot of headwinds for housing in terms of investors. I think home prices are probably going to grow maybe even more than people think, just because the supply situation won't be able to respond to demand.
Interesting. And so when you say then the market has sort of you can see the expectation of maybe 10% growth for home builders, but you figure they're likely to sort of under deliver on that.
Right. Something I've been watching is on my street, 3 or 4 houses down was a lot that a builder bought a year ago to the day, and they tore down an old house and they've been building a new house, which they expect to sell for over $1 million. And I just watched to see like what's going on with this house. And it's really a great sort of microeconomic way of observing the supply chain in real time. And it took them a while to frame the house, but they eventually did. And then what happens is they do one step and then they stop for 2 or 3 weeks, presumably waiting for that next piece of the supply chain to come on board. And it's just been a very, very prolonged process. And they're still waiting for a garage door. I don't see a garage door. I'm sure there are no cabinets inside, no appliances. And I don't know when they're going to finish this house. And they haven't actually listed it yet, because why list a home that you're not ready to sell? Presumably prices will keep rising. And so I wonder, will this home be ready for the spring selling season? When will they eventually list it? What will it sell for? And then I wonder, if you can't build $1 million home in Atlanta, what does that mean for the national housing market for home builders trying to ramp up this year?
Yeah. And it's funny that I redid a kitchen in my mountain house, and I may have told the story on the podcast before actually, but it's like people look at the kitchen, they say, hey, that's a really nice kitchen counter. And I say, thanks. That's the one they had in stock. Right. That's
right.
Why I bought. And do you know, like the local builders, individual builders are notoriously, they're not necessarily efficient in their scheduling and structure.
Right.
But the big builders are, like, that's the competency.
And it could be that, to your point, like the big builders, your D.R. Hortons and Lennars, they're going to get the materials that they need, and maybe multifamily as well, because multifamily is so strong and there are more efficiencies there. And so your one-off local builders trying to build, infill single family homes just get shut out. And even if it's a really high price point, maybe they just can't get what they need to finish homes.
That's even
so I think
tougher for them.
Yeah, to me, the story of this year is really about what can the supply chain deliver, not what's the demand picture. I think demand is strong. Everybody knows demand is strong. It's can they actually build these homes?
Yeah. And does that then change so it is like, we have rising interest rates, we have inflation, we have it's now beginning of February. The stock market's been tanking. Are there risks for that home builder? Like, it's now 9 more months. It's taken me 20 months to build this house, and all of a sudden the demand, things have changed.
It's really fascinating because they're looking at your data too, probably, and saying inventory is crazy. The market's so hot, we might get 10% housing growth, home price growth again this year. But if I start a home in April, when am I going to finish it? Will I finish it in April of 2023? And then where will mortgage rates and demand be then? And it is kind of maybe it's really strong and you kill it, or maybe in the second half of this year or first half of next year, that demand does diminish. And so I think it's a really challenging situation for the market trying to deliver more homes, given supply chains and how long the lag time is, rising interest rates, and what that means for demand in the future. And it's just a really tricky time.
Yeah. So let's talk about interest rates for a second. I am not skilled at interest rates. I bought my first house in the mid 90s, and I had an 8% interest rate, and I locked it in for 30 years because I thought it was going to go up. And then I bought my second house in 2001 at 6 something, and I locked it in for 30 years because I thought it was going to go up. I bought my third house at 4 something, and I locked it in for 30 years because I thought it was going to go. So I'm now locked in at 2.7, and
right.
but so are they finally going to go up?
Well, the interesting thing is, I think the Fed is probably more likely to deliver more hikes this year than people think. So right now, the consensus has shifted to 4 or 5 rate hikes this year. Maybe it's 6. But mortgage rates anchor to the 10-year interest rate, and it's possible that that rate doesn't move that much because people say, well, if they're going to raise interest rates all this, later this year, well, eventually that just means they're going to be cutting them 2 or 3 years down the road if demand softens. And so maybe the 10-year stays below 2%, even if the Fed funds rate that the Fed controls goes to closer to 2. And so for the housing market, I don't know if the 10-year yield is really going to rise that much, just because the market seems to think that raising interest rates now just means cutting them later. And so is that really going to cool the housing market if the 10-year yield doesn't rise at all? So it's, again, an interesting situation.
So is that a dynamic that is at play where the market is? So there's broad consensus we're going to get Fed rate hikes this year, but the 10-year, the people that are buying that are vested in the 10-year have already figured that, and now are looking well beyond that. Is that really that how that ends up playing out?
They actually perversely say, well, if they hike more than we expect this year, it just means they're going to be cutting sooner and faster later. Therefore, you actually want to own 10-year bonds and push interest rates down at the back end of the curve.
Wow. Okay. So that pushes interest rates down to the back end of the curve. And if that gets too out of whack, that's why the bond market would forecast recession, because the bond buyers are saying they're way overdone, and we have to we're gonna be in that bond. We're gonna drive the interest rates down on the far end of the curve, and you get your
and a lot of them are even looking at late 2018, when, as we know, inventory was rising and the housing market was softening. So they say, well, we couldn't pull it off then, so why can we pull it off now? So there's just very little concern of long-term interest rates rising because they don't think that the market can handle it.
Oh, wow. Okay. And so then the Fed looks at the Fed is primarily interested in inflation now. They need to hike to slow down inflation. Ostensibly need to hike to slow down inflation. Does the Fed care at all about the fact that the housing market is nuts?
I think they do, because they're saying, to the extent that inflation is not just a transitory supply chain thing, they say it's maybe consumers they've got all this money in their pocket from the stimulus payments, from wealth effects of the housing market and the stock market. And so part of that is, do they want to at least put a ceiling on asset prices to make sure? I mean, if home prices rise another 10% this year, that's another several $1 trillion in wealth for households, which just goes back into the economy with maybe not refis if interest rates rise, but maybe cash outs. People do renovations. And so they're sort of in an interesting spot where they're trying to raise interest rates to control inflation. But if the long-term interest rates don't rise, and if the housing market is just so strong due to the supply demand picture, if they can't slow housing, then what are these interest rates really going to accomplish in terms of controlling inflation?
Right. Yeah. So then what do they do? Do they hike more?
I think that's the question that we're starting to ask, but it's unclear because we haven't even had that first rate hike. And so, but it's, if we're coming in mid-year and your metrics, if inventory is lower than it was this time last year and the housing market's maybe stronger than it was in the middle of 2021, which is insane. But if we can't deliver the homes and if there's no supply, then that could be the case. And so if you really think that the wealth effect is part of what's driving inflation, how can the Fed, ding the wealth effect to some extent? And that might be a question they're asking 3 or 4 months from now.
Do you have a sense of why the Fed hasn't hiked yet? Even though
it's because,
it seems like it's around.
Until now, they've wanted to not surprise markets. And so because they said we're going to continue asset purchases until March, they felt like this was a schedule that they had to deliver on. But starting in March, just sort of anything goes. And they're telling us that we might hike in March, we might not, we might hike 50. We don't want to tell you anything about what we're going to do going forward. And so market participants are, looking at the pricing and what does the market imply. And then they also look at what the Fed's done for the past 20 years, which is, okay, maybe it's once a quarter. So that's sort of the playbook investors are using to try to figure out what the Fed's going to do.
Got it. That's really interesting. So I saw you had a comment recently about how you could forecast a world where mortgage rates don't really get much above, well, what was the high end of what you were looking at?
4.5, maybe
4.5.
Which, yeah, I mean, that would be the 10-year at 2.5, and it's struggled to even get to 2. So I think that would imply a pretty drastic change versus what people are thinking already.
Right. So that would mean not just Fed rate hikes, but Fed hikes the rates, and the people who are buying the bonds say, wow, Fed's not hiking enough. We're still going to be stronger. And so then they're going to be selling those bonds. So it would have to be significant growth and inflation, even while the Fed interest rates hikes are happening.
And there's sort of this thing where if the 10-year were to really go to 2.5, that probably means the housing market is even stronger than you and I think for the market to sustain interest rates at that level. So it really is kind of crazy right now where it's like heads home prices go up a lot, tails, they go up even more. And I don't think I've ever seen anything like this.
Yeah, it's like, I see that as well with we have inflation, and as I think you said on Twitter, you commented about the best inflation hedge is a fixed rate mortgage and a Costco card.
Yeah.
Wasn't that it? So in an inflationary environment, it's good to own.
Mm-hmm.
And so that generates demand. And then, but in a rising interest rate environment, it's also like motivating people to buy sooner. And so it's like you may.
Right. Well, right now, if you can get a mortgage for 3.5% and you think home prices are going to rise 8 to 10% over the next year as an investment, it's kind of a can't lose thing if the home doesn't fall apart. And you can maybe rent it out and get any kind of rent at all. And it's like, well, I'm already earning 5 on the carry between home price growth and my mortgage payment. And then if I get any rental income at all, it's a free lunch. And in an inflationary environment, it's hard to beat that.
It's hard to beat that. And I'm not sure if we had on a broker, Path and Post Realty, Brad Nix and Becky Babcock, who are from Atlanta, and they're super smart. But they were talking about how they negotiate offers for their clients. And one of the things they pointed out is in an environment like this, where prices are rising, inflation is rising, and rates are still super low, then it makes it really easy to overbid on the house. If you overbid by 5% or 8%, you're giving up a few months of home price appreciation, but your payment doesn't change that much.
Right.
And so that really facilitates this overbidding environment that we see.
Well, and because we all want to look back to, is this the same as 2006, where we got in trouble? But the underwriting is so much better. We're not seeing the same construction levels that we did back then because of the supply chain issues and also builders are just much more conservative than we were then. The demographics are stronger now than they were back then. We actually have inflation, broader inflation. So it's hard to see like what's worse now versus then in terms of if you're worried about a bubble situation. And I don't see it yet. Maybe we get there in a couple of years, but right now I think we're still pretty early in this. which is
That's
kind of scary.
that's great. So, and that's a good transition. One of the things I like to ask my guests, we're in this crazy hot market. Everybody knows it's crazy hot. It seems to be getting hotter. What are the risks? If we look out a year, 18 months, what risks? We have our supply chain problems, but what risks do we have? Are we facing that derail everything? Are there things I'm not seeing?
Yeah, it's. I mean, we've had the ultimate housing bust. So you go back to that, and it's speculative bidding. There's really not speculation. Sort of the way we think of it historically. We had those teaser mortgage rates, so there was the risk that the mortgage rates would implode, and that's not a risk here. The underwriting is really strong. There's very little risk of any kind of oversupply situation in the near term. So I guess it's sort of, if you're in Boise and you pay 50% more than the market price, then maybe you get 6 or 12 months where home prices correct 10% if price growth is really insane. But if you're going to hold a home for 3 to 5 years, I don't see that kind of risk right now. And I think that hypothetical baby boomer supply is still much later in the decade, at least something on a wide scale.
Right. When they finally start selling and retiring and moving into assisted living and freeing up some of that inventory.
I mean, so there will come a point later in this decade where the millennials have largely bought the homes they need, and then the baby boomer supply will come. And that's probably the risk in terms of if you're really worried about some sort of structural issue. But in 2022, we're still pretty early in this. Like the median median millennials probably in their early 30s right now. So they're just getting started, and they probably haven't been able to buy a home yet.
Right. Famously haven't been able to buy a home yet.
Right.
So then let's shift gears a little bit into the millennial demographic, things like job creation and household formation. How should we think about what's going on there?
Well, part of it is that it's easy to look at just what's going on now and say, wow, we've had all home price growth and rent growth is up in the last 12 months. How can that be possible? And it's we underbuilt for 10 years, and then also household formation was very low for 10 years. And so even though household formation is rising, partially due to just the growth of that demographic surge, we were sort of under householded, which is not really a word, but we'll go with it, for a long time because people weren't forming households at the rate that they typically were. And so you have household formation growth plus millennial demographic growth. So you have these sort of two growth drivers that it's been expected for a long time, but it's finally happening. And so it's probably going to take several years for this to play out where household formation growth normalizes and millennials have bought the homes they need to buy. So again, I do think 3 to 5 years from now, we probably have a different situation, but it's still sort of tough in that you can look at the home price growth and maybe at some point you say it's unsustainable, but if demand exceeds supply, prices go up. That's just sort of the way things work.
Yeah, it's all right. Let's talk about investor activity. We've got big hedge funds buying lots of properties. We got individuals buying lots of properties, and that's one of the trends that I've talked about. Try to bring to people's attention. Where the hedge funds get the headlines, but the bulk of the investment home buying is actually with individual investors. Do you see things there? Or are you thinking that like that continues to grow? Have you given any thought about that?
I think
those factors.
It's probably depends on the metro area. So if you think about an investor, the big investors are pretty predictable, where they're saying, what are the metros with great demographics? Because we don't want to mess around with suburban Ohio. It's too like you want that multi-year tailwind so you can show on your investor slides to your investors, like, national demographics are up and to the right. And so they're crowding in the same probably 5 or 10 markets, your Raleighs and Charlottes and Nashvilles and Austins and Phoenixes and whatnot. And then they're looking at, well, what's the part of the demographic curve we want? And it's that entry level, middle class millennial buyer. So maybe that's $400,000 to $500,000. And so that's the part of the market that they want. And so I think if you get that, middle of the pack buyer market in these metros, investors all want to be in the same places. And so if you're looking to buy a home in Phoenix in that $300,000 to $500,000 range, you're competing with your Blackstones and those types of guys. But if you're buying in Maine, it's probably not an issue. So it really depends on where you are in the country and then where you are in the buyer pool as well. And they're also probably not buying $1 million homes in Phoenix either.
Right, that's for sure. And one thing I noticed when I talk to individual level investors is how they've really shifted their focus from the Austins or Phoenixes to the next level of markets, the Memphis and the Mobile, Alabama, or Jacksonville. Jacksonville's exploding right now.
Mm-hmm.
Yeah. Go ahead.
No, I think you're right. It's sort of, and it's, yeah, I think, and since we both lived through 2006, 2008, we're asking ourselves, like, are we the crazy people this time around? But it's not clear to me yet, like, where the downturn is going to come from. Maybe we're just too scarred from the last cycle.
Yeah. Or, it's funny. I was talking with somebody, I think it's on a forthcoming podcast. Maybe I'm scooping myself here, but the interesting comment was, we're so conditioned to resist the phrase "it's different this time." Right? It feels different this time. We're so conditioned to rephrase it to resist that thinking. That maybe the right thinking is it was actually different last time. Like last time was the anomaly.
Yeah.
So
I think thinking about the sort of the labor market story this year, my guess is we're going to add maybe 3 million jobs, and then wage growth is going to be maybe 5 to 6%. And so that kind of papers over a lot of sins if you make a bad investment purchase, just because job growth means home price growth and housing growth. And so it's not like and the job growth we're getting isn't really that tied to the housing market, which again was how last cycle was so different, where you had all these mortgage and home construction related job growth. And outside of that, maybe in a market, especially like San Bernardino, there really wasn't much going on. We don't really have that this summer.
Yeah. So then, 3 million jobs this year. And that is in a world where we're trying to pull the steam out of the economy. And it lags.
Yeah, I think there's so much momentum for the economy this year that the Fed is going to hike. And we've seen that it's spooking markets. But I think next year, if we're going to worry about the Fed hurting the economy and markets, I think next year is the bigger concern, when at that point, maybe supply chain things do start to normalize, and the people who left their jobs during COVID have all come back and gotten a job, and there's less sort of momentum in the economy. Whereas right now, there's just so much momentum, and the only thing holding it back is really the supply side.
The supply side. And in that sense, do you think of inflation? We put a bunch of money in the economy, but it's also could be supply side inflation. How do you view inflation and where it's coming?
Well, I think housing is a great way to think about inflation right now, where if people think we're going to grow home creation by 10% this year, and we only grow it by 5%, well, whereas maybe we would have only gotten 8% home price growth if we actually got that 10% growth in deliveries. But since we didn't, that extra demand just shows up in higher prices rather than more units. And that's probably a way to think about inflation more broadly right now, where if we had the supply, we wouldn't get the inflation. We just get the volume growth, but that demand shows up it either shows up in volume or pricing, and it's showing up in pricing right now.
Yeah. And there's really no sign of the supply easing yet.
Not yet. And builders are all saying we're growing community count, but I joke about it with some other housing people. It's like, okay, you built the road into the development, but you can't get the appliances or the trusses you need to actually finish the home. So I appreciate they're growing communities, and eventually we will get those units, but it's just not clear when we'll get them.
Yeah. And the supply constriction across everything in the economy. So it's not just the housing part. And I have a friend who runs a manufacturing robotics company, and they like tripled their bookings this year, but halved their deliveries because they just can't get, and the demand is off the charts, but the deliveries are extended from a 3-week window to a 9-month window. Or
I think one interesting thought here is how the supply chain bottlenecks all are interrelated. Where it's like if a retailer is struggling to stock its shelves, then it has to get more units on a boat from China, and if those boats are all full with retail units, and that means you can't put windows or housing related goods on them. So to some extent, the housing supply chain is being impacted by other supply chains. And so if those were to get unclogged, then maybe the delivery times would get reduced and housing could get fixed to some extent.
Yeah. So then does this all so we've got the booming economy, but we have this constriction and in your view, which I totally buy, it constricts the growth in the housing market, especially in the new construction. Does it constrict the growth in everything?
I think so. And it's even constricting labor where maybe if you see it with the automakers where they would love to run their plants 24/7 right now, but they don't have the semiconductors. And so that means that some workers are being furloughed while they wait for semiconductors to come online. So as that supply comes, that actually leads to more workers and more, incomes, which then feeds into more demand as well. So there's just all these things pushing for more growth in the economy right now on the volume side, on the income side, on the pricing side. And it's, again, this is unprecedented in my career. And it's, the question is, when does that slow down? And will it happen organically? Does the Fed need to do it? What would that mean either way? But I think those are questions for a later date, whereas right now we're just trying to manage this wall of demand.
Yeah. And so, for our audience, thinking about working with people who are buying homes right now or selling homes right now, the trends are obvious, they're big, and they sure don't look like they're derailing this year.
No, and the hard thing is when you see things like Ali Wolf saying that cabinets are 9 months delayed in her checks, it's like, well, should I just wait a year to get cabinets? And it's like, well, if you get them a year from now, they'll probably be 10% more expensive. So you're not really better off waiting. It's just, if you said to somebody like, what should I do? It's like, I don't have a great answer for you. It's, if you wait, you're going to pay more and you won't get it for a year. And if you buy now, you're trying to compete with everybody else. So it's just a bad situation.
It's really wild that way. So let's look backwards a little bit. Highlights from 2021. What surprised you? What was notable there that we should pay attention to?
Well, I mean, I remember back in the spring 2020, which is when I really started following your weekly videos, and it was seeing housing come back soon didn't surprise me. Like in March 2020, I had a couple friends saying, should I not buy a house? I said, no, like inventory is low and demographics are what they are. You need this house for your family. I would just buy it. But then seeing it come back was like, okay, I buy the bottom. But then when it took off that summer, I think that was really surprising. And there was some thought, well, maybe this is pull forward demand. People were going to buy a house next spring. Now they're doing it. And we were waiting to see that demand slump. And I think the spring of 2021 is, okay, we're going to back off because last year was crazy. And then it didn't. And so I think that was surprising that the peak was really more like the middle to the latter part of last year. And then when supply inventory started growing in the back half of the year, it's like, okay, we're going to get normal to some extent. But then it was probably October where, inventory was pulling back again. And it was, I were talking and it was like, okay, well, this is happening a lot sooner than you would think. And it's like the spring buyer season started in November. And so I think last year was sort of just surprising at how the demand didn't back off. We didn't really get that normalization. And if anything, it's, arguably this spring could be stronger than last spring, which is just completely mind blowing.
Completely mind blowing. Yeah. I was hoping that the fall was getting a little more back to seasonal normalcy. But then all of a sudden it feels like it's not.
Right. And I think this is a new definition of, is this a healthy housing market? I would say no. It's a very strong housing market. It's a very frustrating housing market. But it's certainly not healthy. I don't think on anyone's sense.
Yeah. And it's, I sometimes think of it in, we have the curse of fighting the last war. Yeah.
Right.
And the last war is the crisis is overpriced homes with artificial demand that cratered. And we're all looking and fighting that war when our real crisis is a supply crisis. It's a price crisis for first-time home buyers. Like it's an entirely different war that we're actually facing, but we're all still fighting the last war.
And something that's been interesting to me is watching the home builders and listening to these conference calls, hearing the executives talk about their thought process. Because, if you're just following this market, you would think, why aren't they just flooding the market with homes as quickly as they possibly can? But they're driven by shareholders, and what shareholders want, because they were so burned in the last cycle, they don't want excess leverage. They don't want all that debt. They want steady, predictable growth at high profit margins. And that's what builders have been able to do. They say, we grew 10% in volume, pricing went up, our margins went up, we're buying back shares, and we're going to try to grow 10% again. And they just want to have this steady growth, return capital to shareholders. And part of that's growing volume, but that's not really the goal. The goal is shareholder returns. And so they're not really incentivized to fix the market. They're just operating on their own incentives.
Interesting. Okay. So the shareholders are fighting the last war.
Yes.
And therefore, as a home builder, you're like, well, that's who I got to answer to.
Yeah, you say like I grew book value 10%. We bought back stock. We're growing community count. Our margins are at all-time highs. What's not to like? And they're frustrated by supply chain stuff. But if a worse supply chain just means you raise prices and you make it up on margins, you're kind of okay.
That's really fascinating. That's there are a couple of comments that come to mind in there. One is that it's really fun in the Altos data over the years. The fun opportunities are when we get to be contrarian and bullish.
Right.
So when the market is really thinks that housing is tanking, and we say it's not. Last year in 2020 we had 5 weeks of that, and then the market was turned around. We had actually a couple months of where we got to before the market caught up with the data. A couple months of 5 weeks of down market, and then we had recovery, and so that was a really fun opportunity to be there. We had it in 2011 when the first time home buyer tax credit of 2009 went through April 1 of 2010. And it very much pulled demand forward from end of 2010 into the first quarter. And so by the end of 2010, the market slowed, the housing market slowed way back down again. But in January, February, March of 2011, we could see organic levels of demand picking up. We could see prices rising with no incentives in place. But the headlines were still Armageddon because they were based on the fourth quarter. And so those moments were really there. And then some of the lagging indicators like the Case-Shiller didn't really recognize a home price turnaround until a year later in 2012. And so those are opportunities when it gets to be what's really fun with the Altos data. I'm afraid for the next time when we're contrarian, we're going to start being down first before everybody else. And I don't know what to do then.
Yeah, well, I think about last year when everyone was predicting, okay, when these foreclosure moratoriums expire, a wall of supply is going to hit the market and crush pricing. And we would watch it every week, and it never happened because everyone had made a lot of money in their home. They could sell their house if they wanted to. They could restructure their mortgage, and that just didn't happen. That supply didn't come. And so the last year was maybe the supply surprise was from the foreclosure supply not being there. And this year it's going to be on the builders not being able to deliver. And so the contrarian but bullish is, well, home price growth is going to surge because builders can't actually deliver homes this year.
Interesting. And that's not yet priced into the builder stocks. Well,
the interesting thing, as a public market investor, and I think about, because if you're a specific housing investor, you would say pricing is going to be off the charts this year. Margins are going to be strong. There's infinite demand. Mortgage rates aren't going to go up that much. Why wouldn't I want to own home builder stocks when they're so cheap? But if you're a kind of a generalist investor, you'd say, well, wait a minute. You're just telling me that they're not going to be able to meet their projections for demand this year. And then the Fed's hiking interest rates. Why do I want to own housing stocks? And I think that's why they've actually been pretty weak this year, because people are saying rising rate environment, they can't meet what they're telling us they're going to do. And so I don't want to own the stocks yet. But I think later this year, once that's priced in, they could be great investments.
Okay, that's good. Well, I've proven over and over again that I am not a stock trader. So I will just listen to the voice of the experts on how that might come to pass. Okay, let's talk. We've talked a little bit about the future. Let's talk a little bit more. Let's talk about. So we have some visibility on 2022. Sure looks strong. Sure looks hard to derail. There may be some of the trends we were talking about are 3 to 5 years. We have the millennial demographic trends. Probably that long before we see any volume of boomer inventory come in. What are other big macro trends over the next several years that we should be paying attention to that haven't yet shown up in the Altos data each week?
Well, I think when it comes to housing specifically, the part of the market that's going to peak first is entry level, because like I'm 40. And so, we lived in a smaller home, then we had a couple kids. Now we live in a bigger home. And so I think about whatever I want is like 5 years ahead of the market because I'm just older than most millennials. And so right now they all need that starter home in that $300,000 to $500,000 price point. And eventually they're all going to have their starter home, and then they're going to want their trade up home in 5 to 7 years. But that means they're going to be selling their starter home when they do that. And so if you're looking to kind of like ride the millennial wave for a long time, I would focus more on the trade up market than the entry level market, because the entry level market is crowded and that's going to peak first.
Interesting. Yes. So the entry level peaks first. And I wonder if that has geographic implications. What does that mean for Atlanta, for example?
Right. So it's, if you wanted to own as an investment, I mean, right now you're probably okay, but I wouldn't be buying entry level homes in these hot markets in 2 to 3 years. I think at that point, they might be fully priced. And then you start to need to shift to the next part of the market, which is, it's not going to be McMansions per se, but it'll be whatever the millennial equivalent of that is. What is a 40-year-old college educated millennial going to want in 2030? That should be where the focus should be in a few years.
That's great. That's good thinking. It was part of my rationale for buying my mountain house, right? It's like 20 years, like those millennials are going to be wanting to have their mountain house. Yeah.
and I'm seeing it in my friends. Like, I don't know how old you were in 2008, but you probably were like, oh, blew up, no money. I'm never going to afford all this stuff. And then you get a little older, you're like, I do have some money. And so I think 40-year-old millennials are going to have a lot of money because they didn't live through that housing bust the way that your generation did. And they're going to want really nice stuff. And, catering to that will be more important than just here's a unit in Phoenix because you need to own a home. It's going to be, I want something nice.
Yeah. And so I'm Gen X, I'm straight Gen X. And so I was 38 in 2008. And what that illustrates, one of the things that illustrates to me, and I think maybe underappreciated about that housing bust, is 2008, the Gen X's, we're in our late 30s. That's peak home buying years, but there are fewer of us than either side. And so one of the things that happened was that like there are fewer Gen X going through there, and and all of a sudden demand can shrink because there are less of us. It's sort of like the demographics drive everything argument.
Well, so yeah, this is a great point, because in 2010 you were 40, right? And that was probably like the most broke a 40-year-old crop of Americans has ever been since the Great Depression. And your generation was small. So we went through the 2010s, and outside of like the Bay Area, there just weren't a lot of wealthy 40-somethings because they all got their home equity wiped out. Maybe they didn't buy a house and they were just trying to get a job and rebuild their savings. Whereas I'm 40 now, we see the aggregate household wealth numbers in the US. We're going to have a bigger generation of 40-somethings because millennials are bigger, and they're going to be a wealthier generation of 40-somethings. So that to me is a decade-long theme of affluent 40-somethings and all the stuff that they're going to want between housing and cars and vacations and everything else.
Yeah, that drives a ton. Excellent thinking. Are there things that you're thinking about, themes, macro themes that whether or not they impact housing or not, that we aren't hearing yet about in the media, the conventional wisdom?
I think just we think about remote work in terms of we're on Zoom, we're not in an office, and it's very kind of first order thinking about remote work. But it's to the extent that becomes the future, what's that whole like sort of supply chain is the wrong word. How do you change the economy to serve the needs of, college educated information remote workers? And it's not just a Zoom and a camera in your room. It's like maybe more built out, WeWork type things close to their homes. Maybe it's coffee shops, restaurants they're actually going to go to during the day. So there's going to be this whole ecosystem of businesses that gets created to meet these needs. And right now we've kind of dabbled. We've done a few things here and there, but assuming we get to a post-COVID normal, I think, I don't know if you work from home or have in the past, but it's sort of, there'll be a whole ecosystem created to meet those people. And I think that'll be an interesting thing to see.
And, this is a great opportunity to tell the people who are listening, they maybe have heard me use the phrase Zoom towns. And Conor is the one who coined the label Zoom towns for all these like booming housing economies of the last couple of years. So Zoom towns, in your view, are here to stay, or at least tell us more about that. That sounds like what you're saying.
Yeah, I think they're here to stay. It's sort of, you don't want to be too specific about what they're going to look like in the future, because it's easy just to say, okay, it's a bunch of tech workers going to Tahoe. That's certainly part of it. But I think about, as a parent, it's like, okay, what can I do differently for my lifestyle with my children now that I don't have to be in an office to work? And so, will I take a spring vacation, instead of going just to Disney World, I'll go to a place where kids can do stuff during the day, but I'm going to work, maybe take meetings. And you turn vacation towns into you create more business amenities there as well. So it's sort of a blending of leisure towns and work towns. So it's not just Midtown Manhattan and the Hamptons, which are two separate things. You sort of create a blending, sort of in the same way that tech versus retail, like e-commerce versus retail, it's sort of omni-channel, and they're all kind of intermingled now. We're going to see things like that in real estate, I think, where Tahoe might have a WeWork, or maybe it already does, because there are going to be a lot of people working 9 to 5s in Tahoe doing stuff, and they won't be in an office maybe, but they'll be doing meetings and events and things like that.
That's great. That's a really interesting commercial opportunity.
Right.
Are there the WeWork related things in normally remote vacation places? Like, we've got reliable, fast internet. We've got, you can have your subscription to come work here. It's like, I have a gym membership for when I'm in the mountains too, but having a reliable office space, that's really interesting opportunity.
Yeah, kind of like, what does a mixed use development look like in a vacation town when 30% of the residents are there working?
Yeah. Super, super neat. And you don't think that that's a permanent change? We're not like about to get back into really mostly back in the office.
Yeah. Well, I think you think about, like, over a 5 or 10 year period, what's more likely to become a better experience, the remote work experience or the office experience? And I think both are going to have to compete to some extent, where offices are going to have to become more compelling to draw people in when it's not just, here's your cubicle. So it's, better amenities, more events, a more fun office environment than in the past. And then also vacation towns are going to have to compete to win these workers who can work anywhere. And so we're going to have to see what the winning models are. I think it'll be multiple models, but it's sort of, offices didn't have any competition. Now there's lots of competition.
Yeah. I have a hypothesis that a really compelling office environment is actually going to be a recruiting advantage over a fully remote place. Like if your office is so lame that nobody ever wants to go in there, like, that's a problem.
Right.
You want to be a place where, like, I love going in and working with my people, and it's creative, and and the communication is rich, and as opposed to, like, I'm never going back in there.
Right. It's like, you just built this, all it has is like a rinky dinky, like, deli in the front, and that's it. Like, that's not going to draw people back. Certainly not the workers that you want to come back.
Exactly. That's really neat. I love those concepts on Zoom towns. I love the evolving concept of what really a Zoom town is. And there's a lot to be had there. I like that. I hadn't thought about some of those opportunities. Anything else that people haven't picked up on yet?
I think we've covered a lot of things. It's a really fascinating time, because right now it's sort of, I think 3 to 5 years from now, it's all gonna be very obvious. Whereas right now you're just sort of throwing out ideas, and maybe 30% to 50% work, and you're not really sure which ones yet. But I do think that we're not going back to any kind of pre-COVID normal of 80% of the time spent in the office. If anything, I think companies are going to have to end up being remote first, because otherwise it's like I've got friends who've gone back to the office and they're doing Zoom calls from their desk. It's like, well, why even bother going in if you're just on Zoom? So it's, even companies who are going back to the office find themselves working remotely from the office, and that's just a bad experience. So we're, I think anyone hoping for just normal to come back, that's not going to happen.
Not going to happen. Yeah. All right. Well, that is just terrific. Let's sort of bring it wrap it up let's make sure, where can people follow your work?
So I write for Bloomberg Opinion. I try to write twice a week. Sometimes it's more like once a week. So you can just Google and find me there. And then on Twitter, Conor Sen is my handle. And I tweet way too much, as you know. But I try to keep it to topics that I feel like I have something interesting to say about.
Yeah, that's great. I really appreciate both your Twitter feed, but also that the Bloomberg Opinion columns. I read them like every week. I really appreciate the insights. I loved your take on the Buc-ee's gas station chain, and like share real quick what your observation was there.
Yeah, so Buc-ee's, for those who don't know, is this Texas-based chain of mega gas stations with like 100 pumps, and then it has an attached retail store that's like 100,000 square feet. It's your classic, like, only, had to come from Texas type thing. And so it's really an experience to go through it. And it, unlike a gas station, you're probably spending the 20 or 30 minutes there because they've got barbecue inside and all kinds of stuff like that. And so in a world where we have more electric vehicles and larger charge times, when you're stopping to charge for 20 or 30 minutes, you just don't want this highway gas station where there's, some warmed over hot dogs and combos or something like that. You're going to want a different kind of experience to kill 20 or 30 minutes. And so I think a Buc-ee's type model might be the winner in an electric vehicle highway charging world.
Fascinating. Yeah, I love that. I love that insight. That's super, super great. Okay. That's all the time we're going to take today, folks. My guest has been Conor Sen. He writes for Bloomberg Opinion. You can find him there at Bloomberg and also on Twitter at Conor Sen. Conor, thank you so much for your time today. I really appreciate your take. I appreciate your context, and it's really the reason that we're doing this podcast. So it's not just the data; it's like all of the implications around the data. So thanks for your time today. This is the Top of Mind podcast. You can find the Top of Mind podcast where all the podcasts are. You can also find us on YouTube. We do the videos on our YouTube channel, Altos Research YouTube channel, or altosresearch.com to find all the context. We also share like the transcript and the great takeaways from each of our interviews on the Altos blog. So go to altosresearch.com to get all of those good things. And more soon. Thanks, everybody.
Thanks, Mike.
Thanks for listening to Top of Mind. See you again next time, and be sure to click subscribe to get future episodes.